Hello.
Hello.
Hi, can you hear me? Oh, wait a second.
Yes.
I don't think you can see me
Hear
though.
me?
I can hear you, but I don't think you can see me. Why can
Your video.
yeah, a second. Yeah, cool. Hey,
Hi,
see you
morning.
again.
Nice to see you. Good morning.
Thank you. Good afternoon for me and good evening probably for you. Thank you for coming.
Oh, most welcome. Looking
Thank you.
forward to it. It's tough market because it's so volatile the last few days.
Yeah.
Yeah. So, it's very hard to anchor on a view as well, I find, because the conversations are
Yeah.
and very speculative in terms of, what uh interest rates are going to be. I think interest rates are fine, but it's just the issue about how deep the recession is going to be. That's the uncertainty. And so you can't almost hold a long view. It's quite difficult, I think.
I totally agree with that. I the way that I am trying to think about this is I'm just trying to look beyond like now, today, and tomorrow. There's this kind of like there's the meeting where the interest is going to go. I'm just trying to think about when I look forward to next year, which companies next year will be in a situation similar to this year, because that's easier. I think that it's easier to kind of try and think, okay, I'm very much long natural gas, for example. I think that's easier to think, okay, let's imagine that a company as Antero Resources is in a similar position next year. It's easier rather than trying to figure out, for the sake of conversation, where a firm is going to be, or where Atlassian is going to be, or where Apple's going to be. That's a kind of a more challenging game, because there you're trying to think about where the growth is going to come from. So you see, that's a different type of challenge, because one, you're just essentially, it's a bet, right? You're essentially making a bet of the status quo. You're thinking that next year ends up being similar to this year. I think that's an easier bet than trying to think, okay, let's say that Apple is growing at, let's say, 2 or 3%. And
Yeah, hard to project growth. Yep, you're right.
yeah, like you're thinking to yourself, okay, one part of the equation is what is the growth rate, and the next part of the equation, and really it is important to think about, is what the margins are going to be next year, because that's really dependent. Like you look at something like Apple, you have to think, okay, yeah, I can see where the top line is going, but you don't know the impact of inflation. You don't know. There's lots of different things here. So I struggle. I think it's difficult.
I was looking at your anterior piece and I'm quite interested, but I'm struggling to figure out the logistical challenges of the gas industry, right? I mean, we see that the production of gas for the producers, it's growing, but then they can't get the connection, right? And so if they can't get the connection, they don't get the price anyway. And then the average benchmark price goes down. So that's where I'm struggling. Even though Antero probably's got the capacity and they're unhedged, which is good in some way, but my struggle is trying to figure out whether the benchmark prices will go down, because
like I'm very bullish on Antero, so please, I'm biased, and it's in my interest to talk up this business because I'm invested in it.
Sure.
And so please, think about that, and obviously I will tell you the positives because that's what I think about, but there are negatives like you talked about, right? So for me with Antero is really thinking like this: if I believe, which I think it is, if I believe that next year natural gas prices are $5 or above, I'm sorted. I'm done. Things are okay.
Yeah, but we don't know. That's the problem. That's my issue.
So
how do we?
So let me get to that first. So in the first instance, it's a localized solution, right? It's US based natural gas. What's happening in Europe may have some kind of secondary impact, but we're talking about predominantly US business here.
Correct.
The second part of the equation is you have, and this is a bit more kind of speculative. You have a facility which traditionally export, which is the Freeport LNG, which traditionally exports 20% of the natural gas, and that has come offline, and that may or may not coming back into commission at the end of December or early January. It's supposed to come back in August, and August then went to September, September into October, and now they say middle of December. But let's just pretend that it goes to January, because they keep saying one thing and then it ends up being another. So let's just say at some point this comes back on. So you're in a situation where there's this kind of 20% being taken out of the US. So that's going to be, I think, adding a lot of support. So if you take where the price of natural gas is right now, around $5.50, $6 around there, and you think, okay, it's very, very seasonal. So use more natural gas in the winter periods, and then it comes down and you start filling up your reserves around May time. So it's a time arbitrage. So you buy it April, May into the summer. That's the period you're buying it, and you use it going into winter. So you buy it and then you use it, and then it kind of comes back down. So it's quite seasonal.
So Michael, is the benchmark price determined? Is that like everybody's blended selling price, or
it's on the spot market? So it's people like you and me, or hedge funds or whatever, making a bet. It's on the spot market. Then you can look out to the futures, let's say for the January futures, but the January futures at this moment in time, from my memory, is a little bit lower. So what happens here is that it has an impact what happens in a spot market, but it's just a prediction of where it's going to go in January, for example. So
my concern is that oversupply of non-deliverable gas, right? The stuff that you just probably got to flare out because there's not enough pipelines. That there is a production, we can see some of that happening where there's a production, but these producers are not able to sell it, right? And so they either dump it or they sell it at a very low price, and that marginal price dictates the benchmark price. That's what my concern is.
Yeah, I get that, right? And it's a valid point, because after all, you got to think about two things. First, if you go back the clock 2 years ago, natural gas was around $2, and now it's $5. Okay, so for more than 10 years, it's been around $2. So that's one thing that you got to think about. This is abnormally high. First thing. Second thing, and it doesn't really directly answer your question, but it's just important to kind of put out there. Natural gas and coal is very much interchangeable. So when natural gas goes too high, people that
they'll switch to coal.
Will switch
substitution.
To coal. So it doesn't really answer your question about the supply and demand, but it is kind of, it helps. You have to kind of think about that as well. Now, I believe, and I've been bullish on Ontario and it's gone nowhere. So it doesn't matter what I believe, because I've been very bullish. It hasn't turned out. But I believe that you are in a situation where a lot of these companies in the US are already kind of towards the maximum production capacity. And a lot of that demand hasn't been able to come out. So even if you end up with slightly more supply coming on the market, I think that in 2023, you're going to see more of it come out, first of all, because that Freeport will at some point come back out. The second thing, which I think is quite important, is that I was trying to kind of formulate this in my head. So in Europe right now, if you are an aluminum company or you're a fertilizer company, you need a lot, or a ceramic company, or you make glass bottles, you need a lot of energy, you need a lot of natural gas. And it becomes prohibitive for them to really to produce that. They can't really produce it in Europe. So you have two options. Option one is that the US companies ramp up their production, so they make more glass, they make more aluminium, because there is
energy arbitrage, right?
So
energy cost arbitrage.
And the other thing is that I've seen in the Financial Times, I saw it just a few days ago, is that some companies based in Europe are starting to transition to the US, because the US has much cheaper input feed costs. So
Mm,
you have more stable, more reliable, and cheaper energy input to something that you're
mm,
producing. If you're producing a ceramic, you're producing aluminium, if you want to, anything that's quite energy intensive, you need, your
mm,
input cost is really important to your underlying profitability.
mm,
And it, in a lot of cases, you have two choices. If you're small, you just basically say, I'm going to close because it does not produce in Europe. It's just, it doesn't make sense economically. Or if you're large, you go elsewhere. But that going elsewhere, more likely than not, it may go to something like China, but more likely than not, it's just going to go to the US. So you're going to see even more demand for
yep.
natural gas. And the final thing, and I think this is quite important, out of the COP27, the only fossil fuel that is kind of seen as a green transition energy fossil fuel is natural gas. So it seems to me that this is the acceptable way to go if you want to decarbonize. But I'm happy to kind of open this up to everyone else as well. I don't want to just kind of talk like I know Jeff, you have kind of your views if you want to interject there.
Well, I was actually going to make an quick observation, just short term about Antero. It's actually at this moment, as you may know, kind of bouncing off the 50-week moving average, which provides really good technical support. And there's, I mean, assuming that it doesn't break down below it, which it never has, it should be moving up somewhat nicely from here, at least short term. You know, so it's up
Mm,
over 34 today. I mean, it certainly looks like it has a run up to 40 coming, but of course that's talking short term. And I think your points are well taken about what it's going to do long term. But I like to also keep track of, you know, whether a stock has good support now to move up technically, and as opposed to maybe, you know, being in free fall next week. But I just don't see that with Antero, and that applies to a lot of the oil and gas stocks that have come down. They've come down. They're either finding support or about to find support, and then most likely will move up again. That's one point I wanted to make. Secondly, you know, I think you also have to look at natural gas differently from oil. And I think there's also a strong case to be made that oil prices are going to be higher next year. You know, WTI right now is 75, but there are projections anywhere from 120 to 160 that I've seen from major brokerages for what may happen by the middle of next year. And maybe, but of course that doesn't have to happen for a lot of those companies to do fabulous and throw off all kinds of free cash flow. I mean, one thing you're seeing is just how much free cash flow companies like, well, of course, the largest ones, Exxon and Conoco and EOG, and they're just throwing off tons of cash. And the question is, what are they going to do with this cash? And I think one thing that a lot of the oil companies have come around to realize is that you need to return it to shareholders in the form of either share buybacks or dividends, because that's how you're going to make the sector attractive to big investment. And one of the problems has been it hasn't been attractive enough because of kind of volatile past, the whole environmental movement and the concerns about mutual funds and various brokerages not wanting to be overly invested in criticized area. But I think that as these companies use their free cash flow to make them kind of irresistible as far as how undervalued they may be, and as far as the dividends that are being returned, and special dividends in many cases, then I think we can see the basis for kind of a cycle upward being supported by greater interest in the sector, as well as just the basic shortage of oil, in the sense that, you know, OPEC can only, I mean, they're probably near the top of their capacity. The super majors are no longer investing big money into you know, U.S. fracking so much as they did. But I think 10 years back in, I think 2014 was when the investment peaked in U.S. oil production. And at this point, what you've got is the companies being very reluctant to increase production because it's not in their interest. It's not what their investors want to see. They want to see cash thrown back at the investors and not used to expand the production. And of course, that's counterproductive as far as price as well. So I think there's a good, I believe there's good reason to think that, you know, the XLE, for example, will end up outperforming next year, even though it's been flat for the last 6 months. And that's significant too. I mean, basically XLE has based for the last 6 months. And at this point, and that was after a huge run. So I think it's ready for another run. And that's just my own opinion. It's the opinion of some investment firms and energy firms I've been following. There's this fellow Eric Nuttall you might have heard of, who runs the largest oil and gas, mostly oil investment fund in Canada, and he has a lot to say on the oil shortage angle, and how, you know, we're not anywhere close to moving away from dependence on oil, because it's not only, you know, the obvious uses of it, you know, jet fuel and energy, residential, etc., but it's also that petrochemicals are needed for all kinds of things. Not only, you make plastics, you need oil. You can't substitute wind power for petro and be able to do that manufacturing. I mean, not in terms of the actual ingredients that are needed. So I think that again, we've got a good 10 years of peak demand ahead of us for oil, and there's a very serious question as to whether that can be met. And if it can't be met, then you're going to be paying much higher prices than you are now. The 75 WTI is going to seem like a very, very inexpensive price.
So yeah, Jeff, thanks for your feedback. I totally agree with what you said, and I'm for oil in the long term, but I think the narrative has kind of shifted a little bit in the short term because of the conversations around recession. And so, you know, with recession in the short term, you're going to get lower oil prices because oil is very, very correlated, oil and gas tends to be a lot higher beta than oil as well. And it tends to be, softer when there is a recession. So it's hard to anchor, and obviously the market trades on the short-term news flow, but I'm totally, agreeing with the long-term view. It's just about, I guess, navigating the short term. I'm looking to buy. I'm looking to buy. That's why I was reading up on Ontario, and maybe perhaps if anyone has any ideas on the refinery space as well. Are there any interesting refinery names?
Can I just before going on to refineries, I remember that. I'll just talk very quickly about 3 points that Jeff talked about, and I'm going to open it up to the other guys as well. So the first thing is I'm going to talk about 3 points, so about capital flows to the biggest companies, and then I'm going to talk about capital allocation, and then I'm going to talk specifically about Antero versus the other players. So I'm going to try and go through this as quickly as I can. Right now, the biggest names, the safest names like Chevron have just soared. So there's a flight to safety. The biggest names, the most liquid names that people feel confident with, they're going to be around for the next 10, 15 years. Those are just gone up and to the right. The smaller names, the smaller you get, the more uncertainty there is. That's the first thing I'm going to say. You need at least 2 years back to back, strong performance in energy for people to kind of say, okay, this is here to stay. We are just not even on the cusp of that, because it's been 1 year and it's kind of just flattened out. So you're still at a good point in time. Now, obviously, I said at the start, and I'll say again, I'm talking my book because this is something that I'm bullish about and I could be wrong. Okay. The second thing I want to talk about is capital allocation. Companies that have said to shareholders, we're going to pay you a dividend, are getting rewarded really, really well. And companies that are saying, we're going to do a stock buyback, people are just like, whatever, move on. So in the power of hindsight, it would have been better to just kind of invest in dividend companies in energy and just, not over intellectualize what the buyback will be next year. The market has just been basically dividend, stock goes up, buyback, and if you're kind of building out your balance sheet, people are just like, move, next one. So that's the second thing. The third thing is specifically about the natural gas players. If you look at, let's say, this is two extremes, but if you look at, let's say, Southwestern Energy, their hedge book for next year is approximately 60% hedged. And so you get only 40%. If you're bullish on natural gas, which I am, you only get 40% of that upside. So you get 60% that's kind of hedged, and you kind of like, you kind of, it's like kind of safe way to kind of think about it. But it's kind of like, if you're bullish on natural gas, then perhaps something like, not being really on a hedged position. The second thing is that something like Southwest Energy, they still have approximately like 3.5 billion of net debt. Now, what that means is it's going to take at least another 12 months for them to be at the place where Antero was at the end of the summer. So they're 18 months behind. So for me, Antero already said, like, they're a bit ambiguous, but they said they're going to deploy the majority of their free cash flow back to shareholders. Now, they've been deploying about 60-65%. So if you continue at that rate, like they're going to buy back at the minimum 15% of their company, at the minimum. But the market is not discerning. If you overlay over the past, let's say, month or so, the stocks of something like Antero or Southwestern Energy, it's basically the same graph. The market is not discerning. And this is what I was trying to say before. And I was going to say, it's all one trade at the moment. Like, people are not really thinking. I was kind of an off the cuff comment, but it was just me trying to say, okay, there's not enough nuance. It's very frustrating, for example, days like today where the CPI kind of cools down a little bit and everyone's off to the races, and like things that I believe are kind of junky companies are just basically going to the moon, and things that I spend so much energy thinking about are just like, kind of fizzling around. And that's a challenge, right? You have one aspect of you wants to, the safe investment, the things that are going up. Another aspect of you is thinking about this recession, like, why would I want to be investing in an energy company? And when there's a possible recession coming, everyone knows that energy is not the place. You don't need energy in a recession. I obviously disagree with that, because I think that you do, because I think that I'm charging my laptop right now. If I'm going to go a flight to somewhere, I'm going to catch, I need energy. I think that you do kind of need energy, and I think that energy is less discretionary than people thought about. So I'll just give you a very quick example. Back in the 1970s, when we went into the previous oil crash, from my memory, the demand for oil was approximately, I think it was around this number here, I could be wrong, it was around 50 million barrels a day, and there was about, if my memory serves me right, 80 million of supply, and now it's basically 1-for-1. It's approximately 100 million of demand and 100 million of supply. So it's a much tighter range, and it can easily flick towards like there being a squeeze, which there wasn't in the past. But I fundamentally get the bearish argument. I'm an investor, and I've been pounding the table for this, and it hasn't worked out. And as I look, as of last week or whatever, the WTI is actually lower at the end of 22 than it was at the start of 22 after the black swan took place. So so that's kind of like, I just want to open it up to everyone else now. I've kind of said my bit.
And sorry, one other thing, Michael, I don't think, I think you should give yourself more credit for that, that things haven't worked out. I don't see that at all in terms of, let's take Antero, or since we're talking about that, I mean, Antero was trading at about $23 a share at the end of February when we started talking about these energy companies and the future outlook. Okay, now it's at 34. So it's up 50% since then. And obviously, as we all know, it's been much higher. It's been up in the high 40s, but but I think it's going back. And I think what we're seeing is a kind of a normal pullback, as well as adjustment to the conditions, out in the field, so to speak. But I don't see any reason to believe that Antero is going to be a failure in the end.
Okay, those kind of words.
May I ask what caused the big drawdowns in Ontario? I can see on the price chart,
So
the big
after
swing is
all
quite
of these
large.
all these commodity companies, after March, all of them, like fertilizer, like everything, basically, it all just kind of sold off. There was kind of a lot of excitement, and then the excitement fizzled out. So I can't really say, like, obviously, if I was to say, okay, natural gas prices came down, but everything came down. The whole commodity complex wasn't just, it was aluminium. It wasn't just, and this is what I was saying before, right? So if natural gas price comes down, you should end up with more profitability in aluminium. So it should not be related in the same way. It should be indirectly related. But it doesn't care. The market is like, whatever to this. But anyway, I want to open it up. Like, Dan, you always have helpful points of view, if you can share.
Yeah. I have several comments on what we talked about. To you, you look at the long run. Some junky companies may do this or that, but in the long run, you get paid off. To Jeff, capital expenditures are going to increase for the oil companies this year, not to the extent that they were. If you look at Exxon and the other oil companies recently announced, the big ones, more capital expenditures, but not to the magnitude that there were before. Pearlie, I agree with her. When I look at oil, I look to the futures. And you see the futures not a ton higher than the present. So these guys that specialize in trading oil, they're not too sure about the future either. So I am bullish, and it's a big portion of my portfolio. But like Pearlie, I remain a little bit cautious until I see that the futures look a little bit better.
So can I just, for one moment, just interrupt you very briefly, I promise you. Back in February, Jeff Curry was coming on and telling everyone, okay, oil in 2023 is going to be around 120 WTI. And I can't remember the name of the guy. It's just such a shame. There was the other analyst on from could have been Morgan Stanley or something. On the same day, he said that 2023 WTI is going to be 60. And it was just like, to me, it was mind blowing how asinine to consider that. It's like, how dare you, blasphemy to you. And guess what? Up to last week, right. I saw 70, and I was like, dude, you are within inches of like being so right. And I thought myself, that's what I want to say. So sorry to interrupt you, please.
No, I saw that as well. I dismissed it as much as you did, but here we are, and that's the way it goes. It was an interesting thing on fusion the other day. It's still in the infancy, but that's something to keep your eye on. Fusion power without the waste through the lasers had an experimental breakthrough, a long way to commercialization. But boy, wind, solar, all of that would take a leap forward. That's very early. In lithium, I'm reading about sodium batteries for the future, and they have a lot of disadvantages. Can't carry the load and need a lot more of it per space that they have, but they're making some progress in sodium. Sodium salt is, of course, a very common resource in the United States. So anybody owning lithium stocks should at least look at what's going on with sodium. So I'm optimistic on ALB and some of the other ones, but I'm also not, and heading into next year, I'm not hand over fist investing in them, but I have decent positions in them. So it's a good discussion. I agree with a lot of what Pearlie said. I agree with what Jeff said, and I always follow what you say, Michael. It's a tough world. Investing is a very difficult thing. You can read a ton, like I try to do. In the end, it also comes down to your own gut feel, to your own personal thing of what you're doing.
Sure. So if I may add, I think the US is in a good position relative to a lot of countries when it comes to oil production because of the threat of government price caps and what is that? Profit, profit sharing or whatever. Governments have been threatening to do that, and I think the last month I've listened to the news on the UK as well as Australia giving energy subsidies, Germany of course as well. So that they will have to find some way to pay for it, and obviously that's going to be further taxes, profit taxes on the oil companies. But I think the US is in a better position, and so therefore, I'm more comfortable relative to the US news. But yeah, I mean, I just a snippet to add there. But I also noticed, I mean, I invested quite heavily in lithium, but I've actually taken money off the table. And the reason's because I felt that it was a very, very contentious trade. And also, it's just so many developers coming in and so many explorers coming in. It's just like, if you look at the number of names out there, it's like probably like a few hundred names.
If you read the supply, if you looked at the demand and supply, if car batteries is the way of the future, there is no way with however many companies we have, the demand will so far exceed the supply. And lithium is a very difficult thing to mine. So new guys coming in, there's all kinds of maybe less environmental rules overseas, but the demand for lithium is strong. Again, going back to what I said on sodium, or what are the alternatives? Because some of the big guys are saying the long term, when you look at future prices 10 years out, that they won't be as high as I think they should be based on the demand. So why are they saying that? Like you, it's just something to keep your eye on.
Luke, you haven't said anything. I'm so sorry. I didn't open it up to you. Are you still there?
Yeah, I'm still here. Sorry,
Yeah, it's fine.
just rolled out of bed, so I don't want
please
the
share your
public to
thoughts.
see me.
Please share your thoughts.
I like the Christmas tree there, Jeff, by the way.
Oh, thanks. Yeah, it's all decorated and ready to go.
Cool.
So in terms of energy, the tailwind that I see is, all these airlines, they are ramping up with more airplanes. What do they use? They use oil. They can't run on solar. That's the big tailwind that a lot of people haven't seen yet.
Yeah.
Right.
I'm always astounded by this fact that the country in the world that has the most percentage of the energy coming from green energy is China. I'm always astounded by that. Like 2011, they are like kind of all basically coal, and basically by 2021, it's just basically like a line up, and it's just basically something like 50% of their energy
Didn't know that.
is coming from from the green energies. And
I don't think it's 50%.
I can send you the graph. I'll try and send you the
I believe that.
I think it's about 30%. They're still very dependent on
I will find you the
coal.
graph. I was looking at it. I will send you a graph. It could be wrong. The graph could be wrong. It could be wrong. So, but I'll send you what I was looking at.
They import a lot from.
I could be wrong. But I will.
But China imports a lot from Russia, right?
No, he's talking about green energy.
Yeah,
I understand in the production of it, but they still can't meet their own needs.
Yeah, for sure. Yeah,
Russia's a big importer.
Yeah, but everyone always talks about China carbonizing the world, and actually they're doing like as much as they possibly can. It's just that they got a huge population, and so yeah.
But it's the same with Germany. Germany has huge renewables, but it just didn't generate enough. Because I think if I remember, the data was based on just the capacity. the capacity of renewables out of total energy was probably what, 40% or 50%. It's something really large. It's just that the actual generated capacity is very low because wind has a lot of, redundancy.
I'll just
or what
add
you call
another
it. Yeah.
factoid that I find quite interesting. So back in 20, I think 2011 or something around that, about 10 years ago, in Norway, 5% of their cars were either electric or hybrid, 5%. And in 2021, 90% was either electric or hybrid. And even in that, even despite this transition to energy, the transition to EVs, their consumption of oil continues to trickle higher even now. So it hasn't made a slowdown. Well, it has slowed it down, but it's still trickling higher, even though it just, and that's the number one example of a country that has transitioned to, the EV model that we all aspire to. I just find this interesting.
Mm-hmm.
I changed subject just slightly. I see that the U.S. dollar is basically crashing today, and that's very good, I think, for stocks. Just continuing, bottoms continuing to fall out of the super strong dollar that was really making things very tough, presenting a real headwind to stocks. So we don't have them. That's kind of been removed now, and it seems to me that we can maybe sustain a rally here into the end of the year. Or
be interesting to see that, Jeff. The market's gone from 900 pre-market, it's down to Dow's down to 334. So I would guess the dollar is not quite as dramatic a move. We'll see what happens at the end of the year. I remain bearish going into next year. Sure. The amount that the economy is driven on the American consumer. And the American consumer is starting to pile up debt. So I'm not overly optimistic. I think energy is still a good place. But I'm not overly optimistic.
No, I was only speaking, and I was only speaking of like between now and Christmas.
Sure.
Sure. When you get into first quarter of next year, we may see new lows on the S&P. Yeah. I mean, and that's that. If so, I don't want to be buy and hold through that. But
I'm putting on some shorts into the SPY and to other things. Not quite yet. I hope the market continues to rally because that'll be a good point to put on the shorts. And the shorts won't really hurt me too much because I have, I'm invested 65% in equities. So they'll just put a hedge on the equity positions I have. So
makes sense. Yeah.
I don't think it's a bad bet.
No, it makes sense.
Jeff and I have been playing Sox L. That was fun.
Yeah, it's off its highs today, but
yeah.
Still.
Okay. So
Michael, I really enjoy all the articles. I mean, you write several. They're all common
you're too
theme.
kind, man. You're too kind.
And I like it because they're short. I can digest in a minute what it is you're trying to say because the pile of stuff that I have to read in a day is huge.
Yeah.
But I always enjoy your comments.
Just
so
too kind.
I'm glad you do it.
I'm so grateful. Thank you so much.
Glad to be in a forum.
Thank you so much. What I will say is that we're gonna if you guys would like to maybe join me in a couple of Tuesdays time. I don't know exactly the date because it's going to be over Christmas. Probably won't do anything over Christmas. But the next time, I think Pearly, you won't be able to make because I'm going to go back to 2 hours later so that other people can kind of join in as well. But hopefully at the end of January we can maybe rotate back to this one. I know it's a bit early for some of the US people, but it'll be great if you could join us then in like 4 weeks or so, Pearly.
All you guys, I appreciate all your comments. The ones I read them all and try and learn from them.
Yeah. One thing I really like about this group is we have strengths in number. Different, each of us brings a different, perspective and skills to the table. Like Jeff, I always go to Jeff for technical analysis when I have a feel on a stock. I say, hey, Jeff, what about this? And usually we both come out right. I would say so far 90% of the time.
And Jeff, that's an area I have on my to-do list.